Hi, David here. Today we're going to talk about private lending. Private lending refers to the monetary funding given to a person or company by a private individual or organization that has access to a pool of private funds. It differs from traditional bank lending as it often has non-traditional qualifying guidelines. Individuals may turn to private lending when they are finding it difficult to get finance from traditional lenders due to a bad credit history or even simply being a highly leveraged property investor. Here are some of the pros when it comes to private lending. 1. Quicker settlement. If you are short of time and need a loan ASAP, the approval process for private loans are faster and do not involve as much paperwork. Number 2. Specialized loans. Private lenders often cater for a range of loans and do not stick to the strict rules of traditional funding. This may be beneficial for borrowers seeking short-term finance. Number 3. Having a good credit history may not be necessary. Many borrowers are rejected from banks for having below average credit history. Some non-bank lenders are more lenient and are willing to negotiate terms. Number 4. Easy approval. Non-bank lenders specialize in offering loans to borrowers in unique circumstances. If you have bad credit history, for example, or cannot prove your income via documentation, private lenders may be able to offer you a solution. What are the cons, you may ask? Well, here are some. Number 1. Higher interest rates. Due to the higher risk that borrowers with below average credit scores have, interest rates tend to be higher. 2. Lack of features. Private lending generally does not offer as many features as traditional funding. Number 3. Shorter term loans. Private mortgage loans are only meant to fill the gap between securing additional finance or to fund short-term problems, such as buying a new house or selling an existing property. Traditional mortgages, on the other hand, are usually 25 to 30-year terms. Due to this, private home loans are generally offered for 3 to 12 months, with some going up to 2 years. Often, people think banks are safer when it comes to borrowing due to the high amount of government scrutiny and regulations that they are subject to. But the reality is that private lenders in Australia must also comply with extensive legal and industry codes. Some of these include Australian consumer law, ASIC law, NCCP laws, privacy law, and the e-payments code. The only difference between private lenders and banks is that banks are subject to additional layer of regulation, which is the Australian Prudential Regulatory Authority, or APRA. The non-bank lending sector is actually self-regulatory in some aspects, as it only rewards lenders who have the highest levels of quality and service through the industry awards nights. What are your thoughts? Let us know in the comments below.